For the last 4 decades, retail capital has been mathematically conditioned to equate a standard savings account with safety. But in the 2026 macroeconomic landscape, holding a 4% yield against true structural inflation is not wealth preservation. It is a slow, silent liquidation. The legacy banks are engineering your loss to fund their liquidity. Welcome to the fixed income illusion. To truly grasp the scale of this illusion, we must look at how the definition of safe money was weaponized. In the 1980s, high-yield savings accounts and certificates of deposit actually generated real, positive returns. A depositor could park their capital in a commercial bank, outpace the inflation rate, and compound their wealth risk-free. But that economic architecture has been systematically dismantled. Today, fiat currency devaluation is no longer a byproduct of the system, it is the core feature. Central banks rely on controlled currency debasement to manage sovereign debt. In this environment, the commercial bank savings account has been repurposed. It is no longer a wealth-building vehicle for the citizen. It is a massive, automated liquidity harvesting tool for the institution. Module 1: The Yield Trap and Shadow Inflation. To understand the mechanics of this trap, we must first strip away the public narrative surrounding government bonds and high-yield savings. The traditional banking model relies on an asymmetrical exchange of risk. The retail investor is sold the illusion of absolute security, while the institution aggressively monetizes the deposit. The trap is hidden within how inflation is officially reported. The public is conditioned to monitor the Consumer Price Index, or CPI. But CPI is a heavily modified metric designed to track the cost of consumable goods, groceries, basic utilities, and minor services. It completely ignores the metric that actually dictates class mobility, asset inflation. While CPI might report an inflation rate of 3 or 4%, the cost of acquiring hard assets, like premium real estate, infrastructure equities, and digital commodities, frequently compounds at 10 to 12% annually. Let us look at the ruthless mathematics of the current cycle. If your retail deposit yields 4.5%, but the true cost of asset acquisition sits at 10%, your capital is in a state of severe negative real yield. You are not earning money. The purchasing power of your capital is decaying daily. You are effectively paying the bank a stealth tax for the privilege of holding your digital digits. This is not a flaw in the legacy system, it is a computational necessity. The institution requires your cheap, decaying capital to execute its own high-yield strategies. Module 2: The Liquidity Arbitrage and Velocity. When you deposit capital into a legacy institution, that money does not sit dormant in a digital vault. It is immediately weaponized. The bank utilizes your deposit as base liquidity to participate in the exact same private credit, collateralized loan obligations, and alternative debt structures we outlined in the previous master briefing. This is the definition of institutional arbitrage. The bank borrows from the retail sector at 4%, and deploys that same capital into senior secured corporate debt yielding 12 to 15%. But the math goes even deeper due to the fractional reserve system. Through the velocity of money, banks can lend out a multiple of your original deposit. They are not just capturing a spread, they are multiplying it through leverage. In the current high-rate environment, this arbitrage has widened to historic levels. Commercial banks are reporting record net interest margins, entirely generated by the gap between what they pay you and what they earn in the private markets. The fixed income illusion relies entirely on keeping the retail investor completely blind to this spread. The bank acts as a toll bridge, charging you inflation to access the actual yield engine of the global economy. Module 3: Bypassing the System. The 2026 wealth flow requires a structural pivot away from unsecured retail banking products. Institutional wealth is not built by accepting the bank's baseline yield. It is built by bypassing the middleman entirely and participating directly in the underlying asset class. This is where systematic yield engineering becomes critical. By shifting capital from passive retail deposits into short-duration fixed-income alternatives and private credit structures, the investor effectively becomes the bank. The first mechanism to bypass the legacy trap is the strategic use of ultra-short-duration sovereign debt, specifically Treasury bills. While long-term government bonds carry massive interest rate risk, short-duration bills, ranging from 4 to 13 weeks, allow capital to capture the highest point of the yield curve while maintaining maximum liquid optionality. It strips the commercial bank of its cut. However, the true acceleration happens in the private markets. High net worth capital is increasingly flowing into business development companies, or BDCs, and closed-end private credit funds. These vehicles allow non-bank entities to pool capital and lend directly to the mid-market corporate sector. Instead of a bank taking your deposit and lending it to a tech firm building AI infrastructure, you bypass the bank and lend directly to that infrastructure project through a secured credit vehicle. By executing this shift, you transition from an unsecured depositor absorbing inflation, to a senior secured lender capturing the illiquidity premium. You capture the full double-digit yield spread that legacy institutions previously kept for themselves. The transition from a retail saver to an institutional allocator begins with recognizing that standard fixed income is no longer a safe haven. It is a depreciating asset class meticulously designed to subsidize institutional growth at your expense. Conclusion: the wealth flow mandate. The era of passive wealth preservation is permanently closed. In a financial system engineered to devalue the base currency, protecting capital requires an active, clinical approach to yield optimization. It requires stripping away the emotional comfort of the traditional bank, and adopting the ruthless, systematic mathematics of the private markets. The fixed income illusion has been exposed. The architecture of true capital preservation is now completely in your hands. You have a choice: you can continue to be the cheap liquidity that funds the institutional machine, or you can restructure your assets to capture the yield yourself. Evaluate your exposure to negative real yields. Map your transition into alternative debt structures. And secure your baseline before the next liquidity squeeze. This concludes the master briefing. Signal over noise.